2/3 of the participants in a University of Chicago poll felt they paid too much in federal, state, and local taxes. Well, that shouldn't come as a big surprise, right? I can't imagine that any of us think we pay too little in taxes. But let's examine that phrase, too much. A research study by CPA Practice Advisors reveals that the average American will pay approximately $525,000 in combined taxes over their lifetime. Based on my calculations, that total tax liability number jumps to about 1.3 to 1.4 million for citizens working in middle and higher paying jobs. Given this tax frame, how is it that several of the wealthiest Americans, the billionaires, avoided paying any income taxes or hardly any income taxes in specific years? How's that possible? It's not like they can just decide to skip paying the taxes, because like you and me, they're subject to tax audits. The answer is that they know the game of taxes, or more specifically, their financial advisors know how their tax liability is calculated and effective tax minimization strategies. It's like coaching a sporting team. You know the rules of the game. You can see the weaknesses, the strengths of the opposing players, and you design strategy to win. Now, the rules governing the game of income taxes are involved. You might think or view tax code as a living and breathing system that evolves over time. But here's the deal. You don't have to know all the details of tax law in order to meaningfully reduce your taxes, because the most impactful tax minimization tactics are linked to 6 social objectives. You see, Congress offers substantial tax breaks to citizens who exhibit behaviors aligned with achieving these broad social goals. These specific tax breaks are the low-hanging fruit for reducing your taxes and, at the same time, positioning you for meaningful wealth accumulation. Okay, so what are they? The 6 social objectives driving meaningful tax savings are: 1, family formation, including the purchase of the home; 2, pursuing higher education; 3, saving for your own retirement income needs; 4, planning for potential healthcare expenses; 5, supporting economic growth by investing for the long term; and 6, perhaps the crown jewel of tax minimization, starting a business. When you engage in one or more of these activities, you reduce your tax liability and you build future wealth. Now, I intend to cover these topics, these issues in more detail in future videos, which you'll be able to access on the Stern Standard channel. However, let's briefly examine each of these social objectives and how they can impact your tax liability. Family formation. The benefits associated with family formation include tax breaks for home ownership and favorable income tax brackets. As a homeowner, you're able to write off your property taxes and qualified home loan interest subject to annual caps. Moreover, when you sell your family home, one in which you've been living in for at least 2 of the last 5 years, you may be able to shelter all or a meaningful portion of the long-term capital gains. When you file taxes as married filing jointly, you benefit from favorable tax brackets, higher standard deduction, and higher phase-out caps on tax benefits. Higher education. Congress seeks to encourage citizens to pursue higher education because that will lead to greater economic growth and higher levels of productivity. In order to incentivize the pursuit of higher education, Congress provides for educational tax credits, subject to caps and maximums in a year. Tax credits are like golden tickets. They reduce your taxes on a dollar for dollar basis. Also, citizens will have access to federal financial aid. They can write off qualified student loan interest subject to an annual cap and a phase out. If you're funding your tuition and fees through employer reimbursement, those reimbursement dollars, again subject to a cap, will be received tax-free. Earning an advanced degree positions the taxpayer for potentially higher annual income with a current year tax reduction. The failure of taxpayers to save for their retirement income needs has some severe negative consequences, including putting a future financial strain on government programs, causing greater reliance on Social Security income, reducing future consumer spending, and the potential for creating a cycle of financial strain on future generations. To avoid those negative consequences and incentivize saving, we are given numerous breaks, including contributions to traditional IRAs, to employer qualified plans, are not considered taxable income in the current year, subject again to annual limits and phase outs. Now, for IRAs, that money will not be taxed until you eventually withdraw it. The money within those retirement accounts will grow tax deferred, and based on eligibility, you might be eligible for a saver tax credit. Employers are incentivized to participate in their employees' retirement savings plans. When they adopt a qualified plan, they're able to write off their contributions as a business deduction. The employer's contributions, the employee's deferrals are both removed from income taxation in the current year. The assets grow tax deferred, and again, not taxed until withdrawn. By doing this, you lower your current income tax liability while enjoying tax deferred growth. Now, Roth IRAs, Roth 401ks are wonderful saving vehicles. I'll address those in a future video. These vehicles work a little different than the traditional IRAs and the qualified plans. Planning for your health care. Now again, failure to own a healthcare insurance policy can be financially catastrophic to the individual and their family. Additionally, a negative consequence is increased burden on government programs, including Medicaid. Well, to encourage citizens to plan for their own health care and to encourage employers to also participate in this, the government works on making healthcare more affordable and offering the tax breaks. When you own an individual policy, you'll be able to write off your contributions as a below-the-line deduction. At the same time, you're writing off the contribution subject to exclusions, and from there, receiving the benefit tax-free. When you participate in your employer's healthcare plan, the employer and the employee premiums are excluded from income in the current year, and again, healthcare services are received tax-free. Healthcare has double tax breaks. Write off in the current year, tax-free services when you need them. As a policyholder, you are lowering your current tax bill while protecting your assets from liquidation or erosion. There are three sets of income taxes when calculating your regular tax liability: ordinary income taxes, short-term capital gain taxes, and long-term capital gains. Ordinary income tax rates and short-term capital gain rates are effectively the same, and they're significantly higher than long-term capital gains. This is the incentive to invest for the long term. The word long term refers to 1 year plus 1 day or longer. So if you hold a security for over a year and sell it, it's going to be taxed at the much more favorable long-term capital gain rates. In fact, for taxpayers in the lower ordinary income tax brackets, they may pay zero capital gains. By investing for the long term in a diversified portfolio of securities, you're building wealth over time at a reduced tax cost. The number one way to significantly lower your tax bill while building your wealth is to start a business. That might be a full-time venture, a part-time venture, even a side gig. When you start a business, you have the ability to generate meaningful cash flows. You're able to write off expenses, including depreciation. You could adopt a retirement plan, which would defer some of that income that you're receiving, some of those cash flows. You could add a healthcare plan. You may be able to claim business tax credits, and you can leverage growth with tax-deductible business loans. In some cases, you'll be able to shift some of your personal expenses over to your side business as a business expense. Of course, it depends on what is the nature of that expense. Did you know that the number one way to become wealthy in this country is to start a business? There are so many revenue and tax reduction opportunities. In this video, you learn how to meaningfully reduce your federal income tax by taking actions that forward any or all of the 6 important social objectives: family formation, higher education, saving for retirement, planning for health care, long-term investing in starting a business. When you do that, you, 1, lower your current year tax bill. 2, you'll be able to recognize surplus cash that can be used for some of your other goals, some of your other objectives. And 3, you are positioning yourself for future wealth accumulation. If this video has spurred your interest, then I invite you to watch other videos that I'll be posting on this personal financial planning topic and other pieces of the personal financial planning puzzle. Once you're confident that the video content is valuable to you, then please consider subscribing to the Star and Standard channel. Well, thank you for watching. Have a great day, and see you during the next video.